U.S. natural gas futures moved back below the $3.20 mark, hovering close to levels not seen since June 2021, as forecasts for lower heating demand over the next 2 weeks offset a drop in output as cold weather caused wells in some producing basins to freeze. Keeping a floor under prices were expectations that the Freeport LNG export plant in Texas would finally resume operations after a 7-month outage. Freeport LNG, the second largest U.S. LNG exporter, said earlier this week that it had finished repairs to its plant and asked U.S. regulators for permission to take early steps to restart the fire-idled facility. Freeport LNG has formally asked federal regulators to allow preliminary work to restart the 2.38 billion cubic feet per day terminal. The overnight forecast trended warmer from January 31 to February 2, but trended colder for February 3 to 8, overall adding 1 HDD. The theme has been for widespread cold in forecast days 11 to 15 to trend warmer as they roll into forecast days 4 to 10. But most importantly, the overnight weather data remained plenty cold enough from January 30 to February 6 to still be considered solidly bullish as frigid Canadian air impacts much of the northern and central U.S. with frosty lows of -20s to 20s. Still, the analysts predicted renewed downward pressure on prices once forecasts in the 11 to 15-day window allow the market to see through the end of the cold spell. Meanwhile, from a technical standpoint, based on Monday's price action, the natural gas market seems to have suddenly lost its downside momentum and could be bottoming. Unless natural gas can get its downside momentum back by Friday, the risk is a spectacular short covering rally. If the long liquidation has ended, watch out. Natural gas is cheap fundamentally and technically. It is obvious that the market is oversold. So that's probably the only real significant amount of reasoning for bullish pressure would be a short covering rally toward the $4 or 50-day moving average levels.